What does the rest of 2022 hold for equities after such a turbulent year? The market activity so far this year could be a microcosm of what's to come. Welcome back to the channel. In today's video, we'll be showing you how are big macro clouds threatening the market. Before we get into the video, don't forget to drop a like on this video and subscribe to the channel if you haven't already done so. Make sure that the post notifications are turned on so that you never miss a video from us. Without further ado, let's dive in. The positives and negatives are fighting it out. It is not unusual for the US Federal Reserve to begin adjusting policy and lowering liquidity at this point of an economic recovery. Tightening financial conditions put pressure on stocks, particularly those that are more speculative. Nevertheless, corporate America's fourth quarter profit results were mostly positive. Despite the fact that earnings disappointments dominate the news, consensus earnings expectations for the S&P 500 for 2021, 2022, and 2023 are higher now than they were at the end of 2021. In April, frustrated investors received no reprieve as the stock markets in the United States continued to decline. In April, the Nasdaq Composite dropped 13.3%, its worst monthly performance since 2008, while the S&P 500 dropped 8.8% and closed the month at levels last seen in May 2021. The sell-off has wreaked havoc on some of the stock market's biggest names. The Nasdaq 100, a stock market index of the world's largest non-financial corporations, is in a bear market, having fallen more than 23% since its all-time high in November 2021. Although other variables are at play in the S&P 500's third worst start in history, the current earnings season has been particularly unpleasant for IT companies. Inflation is forcing the Federal Reserve to raise interest rates more aggressively. Market participants are concerned about global economic development as a result of high oil prices, the Ukraine conflict, and an increase in Chinese COVID-19 cases. Fed Chair Jerome Powell added to the late April sell-off by announcing that a 50 basis point hike in the federal funds rate was on the table at the upcoming FOMC meeting on May 3 and 4. According to Sandy Villier, a portfolio manager at Villier & Co., continued volatility is likely in May as markets anticipate larger Fed rate rises and other sources of uncertainty. Fed policymakers are considering their most significant rate hike since May 2000, with traders predicting a more than 90% chance of a 75 basis point hike in June, which hasn't happened since 1994. Furthermore, market participants have increased their forecasts for the number of rate hikes this year. By the end of 2022, they expect a greater than 60% chance that the funds rate will be at least 3% or higher. Only a month ago, this viewpoint was considered an oddity, with a probability of only 7%. The Federal Reserve is operating in a perilous monetary policy environment. When the economy has overheated and inflation has risen in the past, it has tried to tighten the screw on interest rates, but unjust inflation is the issue now, according to Paul Aniana, the director of research at James Investments. To add to their concerns, central bankers want to avoid eroding market trust, he says. To make matters worse, the present episode of rising inflation shows little indication of abating. Oil prices rising due to the conflict in Ukraine and further COVID-19 lockdowns in China can increase the strain. The GDP of the United States unexpectedly fell in the first quarter of 2022, while analysts remarked that the dismal headline figure was largely due to anomalies and technical issues. The most important portions of the first quarter gross domestic product GDP report indicated increases in consumer spending and business investment. Exactly the factors that will contribute to better GDP growth in the future. Despite the fact that the current economic expansion is already 2 years old, some commentators are already concerned about the next downturn. In this way, the earnings season provides valuable context. Investors are paying close attention to quarterly results from individual companies, particularly guidance on future performance, to gain a sense of the rate of development and if consumers can withstand further price hikes. So far, earnings for the S&P 500 have outperformed expectations. Market volatility will persist and investors should be aware. Stock market indexes may continue to fluctuate between gains of more than 1% one day and losses of more than 1% the next. The bond market is attracting investors who are tired of the stock market's volatility. Money poured into several bond exchange-traded funds at unprecedented levels in the first quarter of the year, ETFs. Furthermore, for the first time since 2019, the yield on the benchmark 10-year Treasury note surpassed 2.9% in April, increasing more than 25%. For years, the bond market has been disregarded in favor of the high-flying stock market's outsized gains. However, if rates rise, bonds may face increased competition from dividend-paying equities, particularly among investors seeking consistent returns. It's possible that more people may put their money into the bond market. It's not just treasury bonds that are garnering investors' interests. Starting in May, I-bonds, a sort of US savings bond designed to preserve the value of your money against inflation, will yield an anticipated 9.60% annualized return. Ultimately, business is doing better than Wall Street predicted. Add in the return of robust corporate stock buybacks and you've got yourself some positive news for stocks. The confrontation between tightening financial conditions and positive earnings news from corporate America could characterize most of the year, which is not unusual for the third year of an economic recovery. Investors shouldn't allow the bears to scare them away from profiting from market declines, but they also shouldn't pursue profits when the market is strong. In the end, 2022 may be a good year for the stock market, but not as good as in the recent years. Despite the decreased returns, 2022 should provide more tactical alpha-generating chances at the allocation level. Here are some options for those who want to go deeper into the market. For two reasons, US value stocks remain dedicated to a value bias in the United States. The first is that value equities have a tendency to become extremely inexpensive during recessions. They tend to trade back to normal levels after recessions. They aren't quite there yet. The second reason is that the economy is approaching a period of permanently higher inflation, and if this occurs, inflation-sensitive companies in the value bucket might outperform for a long time. Given the severity of recent underperformance versus the entire market, growth technology stocks are less bearish on growth than they have been. The rush into growth technology stocks after the COVID-19 lows resembled the Nasdaq bubble of 2000 in many ways. It has been said that when the bubble burst, it would be ugly, and it has been. The more established mega-cap technology stocks, on the other hand, never traded at such a frenetic level. This is how the climate now differs from that of 2000. Many of these large-cap growth stocks are presently trading at very affordable values due to recent underperformance despite numerous good earnings announcements. We frequently hear from strategists that this is the year to favor Europe over the United States. True, European equities are less expensive and have a higher value tilt, and there are chances in select European stocks this year. However, analysts are skeptical about the broad substitution of lower-cost European stocks for higher-performing American stocks. Asia, ex-Japan, and the region of the world where corporations have compounded at rates comparable to the best in the United States. While the region struggled in 2021, it is a better place to invest non-US assets than Europe. The stock market's volatility, as well as the rush to safe haven assets like bonds, indicate the current level of market uncertainty. May will likely reveal whether the worst of the sell-off has passed. Many investors will be looking to see if there is a buying opportunity for tech stocks that have been left for dead, or if it is a more of a wait-and-see situation. For investors, this is the million-dollar question. Long-term investors can take comfort in the second quarter of 2022, which is expected to be a stronger time for economic growth than the first. Meanwhile, concentrate on diversifying your portfolio by purchasing shares of companies with strong balance sheets and the ability to pass on price rises. Finally, even long-term investors can profit from short-term changes when markets are volatile. The best stock market opportunities arise when worry is at its peak, he says, adding that the market should recover as some of the current sources of concern fade as summer approaches. With this, we have come to an end. The content in this video is for educational purposes only and hence should not be considered financial advice. All of the financial decisions should be made after doing your wide spectrum research. Do let us know in the comment section below. Also, make sure that you like this video, comment down your thoughts regarding this video, and also do not forget to subscribe to our channel to stay updated about the latest videos. Until then.